So what does it mean that the US Federal Reserve will break the stock market in 2024? Well, I think there are three things that come together to explain this idea. The first one being the idea of a Fed pivot. And all this means is that the US Federal Reserve, captained by Jerome Powell and others, are going to start lowering interest rates, or it's very likely that they will in 2024. What this means is that they're going to cut interest rates. They're going to also start buying treasuries, bonds, and other assets, including a lot of America's debt, to help artificially prop up the economy and encourage more spending. This whole collection of movement from the Fed is known as quantitative easing, or the term QE. Now, Jerome Powell has already gone on record saying he believes about 2 or 3 interest rate decreases will happen in 2024. This at least gives us a signal that the Federal Reserve is considering rate cuts in 2024, which will have an impact on the market in a negative way, as you'll see in the rest of this video. But what this means is that the Fed is close to pivoting, and there could actually be more than 3 cuts as we go through and kind of just progress what the market thinks is being priced in right now. They're looking at anywhere from 6 to 7 interest rate cuts, which would drastically drop interest rates throughout the calendar year. So if there are 3 or 7 or somewhere in between those two, there is going to be a significant effect on the stock market. It's going to be similar, whether it's 3, 7, or in between, but it's going to react in the same way. Just the magnitude will be less or more on the stock market as a whole. So the first piece here, the Fed pivot. When they start cutting interest rates, it's historically a bad sign. How bad? That takes us to step number 2 of this idea. Historically, when the Federal Reserve starts cutting interest rates, it is a terrible precursor for the stock market, meaning the market sells off in a major way. Some of the biggest rate cuts in history have come in 1989. The stock market dropped 15%. 2001, down 45% afterwards. 2008, the big kind of housing bubble collapse, interest rates were slashed. A 50% stock market decrease followed. We've got 2019, an effective sell-off of 20%, and potentially more coming in 2024. What history has told us is that when the Fed cuts rates, the stock market goes down. It is a historical pattern. You can see it on the chart right there that I'm sharing. And that if we take this one step further on another chart, we can see the correlation between the actual federal benchmark for the US Federal Reserve and the interest rate that it has there. And we can plot that against what the stock market did, or how the stock market responded when that blue line started to go down or interest rates were cut. The stock market sold off corresponding moves, and you can see that visually. It is not a good thing when the Federal Reserve starts cutting interest rates. And this, to me, this chart is just a little golden nugget of information. I hope it is for you as well. If you're getting some value out of the video so far, click that subscribe button. And now let's look at the third piece of this idea and bring it home with how you can protect yourself and trade accordingly in 2024. So we know that 2024 is likely to bring on federal pivoting and the interest rate cuts. We understand the relationship between interest rate cuts and what it has an effect on the market. Now, we need to know when those interest rate cuts may happen. And to do this, we just have to find a calendar for the interest rate meetings for the Federal Reserve. Here they are right there. These are the meeting and the dates where the Federal Reserve will decide if they're going to cut the benchmark federal interest rates. So you can put those in your calendar and track those dates for 2024. When you start seeing interest rate cuts happening, it should signal that some pain is coming or will happen for the stock market. So what you need to know now, when you have those dates in your calendar, is if things do start to get chopped down and the rates do start to decline, how can you profit? How can you set yourself up to gain from the overall market loss? There's 4 really simple ways you can do this, starting with the least aggressive, and these are all bearish strategies for you. The least aggressive way to do it is if you already have stock in your investing or trading account, you can do what's called selling a covered call. You are just selling a contract, an options contract, and getting paid to potentially having to sell shares of your own stock that you already own, so you're covered. And if a price does hit a certain level, if it declines, you get to keep this profit or this cash that you get paid, known as premium. You don't sell any of your stock. So it works really, really well when the markets decline. You can make a lot of money quickly on the stock that you already own. The second way you can profit is to buy put options. These have a defined risk upfront because you understand exactly what you're putting into the trade, how much money that is. And when you buy a put option, what you're doing is buying a contract that you're betting on the market to go down. If it does, you make money. If it goes down very quickly, you make a lot of money very quickly. If it doesn't and doesn't move at all, you lose your initial investment, or you can lose a portion of it if you close the trade out without taking the full on loss. If the stock market was to rise after you buy a put option, you would be losing money at a quicker rate. But again, your loss would be capped at the original investment that you chose to make when you bought the put option contract. Now, getting a little bit more aggressive in this scenario, it depends on your strategy as a short, mid, or long-term trader. You could sell some of the stock that you have in your account, thinking that if the market is about to decline with these rate cuts, then you could kind of sell now at the top and buy back in, just hold that cash in your account for 6, 10, 8 months, let's say, and just buy back at a lower cost basis and hopefully catch the bottom and ride it back up. It's often said, though, that it's very hard to time the market. It's better just to stay invested. So this is why it becomes a little bit more risky if you want to try and do that and try to make those stock plays, but you have some data to back yourself up now. Maybe it's kind of the scenario where you do a little bit of both, sell a bit here, keep a little bit more long-term, and do the kind of the covered calls option on it. It's up to you and your risk portfolio. And the last way you can be aggressive, super aggressive, is to short the market. What this involves is taking a short position on the S&P 500, on the NASDAQ, on individual stocks that you think will decline in 2024 once you see those federal interest rate hikes starting. The idea being that once the rates start to go down, the stock market will follow suit. So if you can position yourself with shorts at that time, again, if the market goes down and you have these shorts on, you're going to make a lot of money very quickly. If the market stays where it's at or goes up, you would be then on the losing end. And this is very risky because it is a potential uncapped loss. If you're shorting and the stock or the market just keeps going up and up and up, you could realistically lose everything in your account. So always do your research, understand what getting involved in shorting is, but it is a bearish scenario for this setup that could work quite well if the market does respond the way you want it to. So, do you believe that the stock market is going to decline in 2024? If you do, let me know in the comments and how you're going to position your trading to take advantage of that. And if you want to see how I set up my own trading in my options trading account day to day, check this out.